Welcome students. So now in this class we will learn about the projected balance sheet, preparation of the projected balance sheet for the one subsequent year, one projected year. So the basis for that balance sheet would be the balance sheet of the Pearl Enterprises in the year N. And as you can see that this balance sheet is given to us already. You call it as a statement or you call it as a balance sheet. So this information is available with us, and as discussed in the previous class, on the left hand side we are given the liabilities, or you call them the sources of the funds in a way. So these are the sources of the funds and these are the basically applications of the funds, right? These are basically applications of funds. So how much funds we have raised from different sources? Maybe it's in the form of equity, that's entrepreneur's investment. Then other equity means appreciation of the equity by way of the reinvestment of the profits or retained earnings, right? You have seen something like that, the retained earnings here. Retained earnings means that part of the profit which is reinvested back into the business. So because of that reinvestment of the profit, so this becomes the other equity here. This is the other equity here. So when we can say the other equity means this is the say part of the profit, which is because part of the profit is given to the entrepreneurs. If it is a public limited company, then it is in the form of the dividend, and if it is a privately held company or a partnership firm, then they also have some part of the profit, and that is retained by them for their personal expenses, and some part of that is reinvested back into the business. So that becomes the retained earnings. So that retained earnings is called as the other equity. So these two are the internal sources of the funds, right? These two are the internal sources of the funds available with the enterprise or with the project, and remaining are the external sources of the funds. You call it as the borrowed funds. So we borrow the funds in the form of secured loans, in the form of unsecured loans, in the form of current liabilities, and in the form of provisions. So two sources are there. Broadly, if you divide here, these two sources are: one is the internal sources of funds, 120 million is the internal source of the fund in the current year's balance sheet which is shown or in the statement shown, and remaining amount is going to be brought by way of the borrowing. So total balance sheet size is going to be 360 million in the current year, and out of this the internal fund is going to be 120 million, remaining is going to be making it as a total 360 millions, which will be partly secured loans 80 million, unsecured loans 50 million. Current liabilities means short term borrowings for the purpose of working capital, short term borrowings from the banks or financial institutions or maybe the sundry creditors, different sources are there. So these current liabilities are going to be of 90 million, and provisions are going to be of 20 million for the future payments. So they are the liabilities on us. 20 million means some payments which have become due or maybe will become due in the future. So we are keeping 20 million for that. So because of those payments, provisions means which we are going to pay in the future, not in at the moment, at the current moment. So 20 million are going to be saved with us. So that will act as a source of funds with us for the current requirements. So these provisions are only for the provisions for the future say exigencies, not for the current. So currently this fund is available with us. So total 360 million are available with us, and these 360 million are going to be used to buy that 180 worth of the million. We are going to have the fixed assets. We are making no investments because we are just a new firm, so we need the funds for creating the assets, both long term and the short term. Current assets, we have the receivables, means we are going to manufacture and sell on credit for 80 million, and inventory is going to be for 80 million. We have to keep the inventory of 80 million, and 20 million of the cash we are going to keep. So these, on the one side we are depicting the sources of funds, on the other side we are depicting the applications of funds, means where the funds will come to the business from and where the funds will go to means in the business for creating different kind of the fixed and the current assets. And total size of the balance sheet is this 360 million is going to be. So out of this balance sheet for the year N, right, we are going to prepare the projected balance sheet for the next year, right. So for that purpose we will be using the information partly given in the projected income statement for the N+1 year, and similarly then the additional information which is given here with regard to the assets and liabilities, sources and applications of the funds. So with the help of these three sources of information, we will prepare the projected balance sheet. As we prepare the projected cash flow statement, we are going to prepare the projected balance sheet also. So in this case we are going to prepare this balance sheet, and if you see here, this balance sheet is projected balance sheet is going to serve a very good purpose. It's going to help us to understand that how the projected financial statements are prepared. So we are going to prepare this projected balance sheet for n plus 1 year. Projected balance sheet for n plus 1 year, right, for n plus 1 year, or maybe actually we have to write it as on, means when actually the date is given to us or the time is given to us, but since that is not given to us, so we are going to prepare it for n plus 1 year, projected balance sheet for n plus 1 year, and we are preparing it in the vertical format. So on the top we are going to put the sources, or you call it as the liabilities. So we are going to put the liabilities oblique equity on the top of the balance sheet, and then we will put the assets, and then we will try to tally both the sides and try to see that from the original balance sheet for the current year of 360 million, what is the size of the new balance sheet for the first projected year, that is n plus 1 year. So in this case we will start with the liabilities and equity, and first thing, if you remember, that to given us was that is the share capital, right. This is the share capital. What was the share capital given to us? So we will prepare a statement here. So we will prepare here opening balance. This is opening balance of the amount, and we will write here changes during the year. Changes during the year. Changes during the year, and finally we will calculate the closing balance. Finally we will calculate the closing balance, right. This closing balance is important for us. This closing balance is important for us. So share capital was how much? If you go back to that, say, original balance sheet, you will find out what is the share capital. Equity. Equity is given to us here, it is the 100 million. So in this equity, so we are going to take 100 million here. Opening balance is how much? 100 million. Changes during the year is nil, right. There is no change during the year. So we are going to put here as the 100 million. So this is the rupees million, you call it as rupees million. So we are going to write it here. So this is 100, no change is going to be here. Then you are given the next item is the reserve and surplus. Next item is the reserve and surplus. So what was the original reserve and surplus? Original, if you see the balance sheet, that is given to us is the 20 million, and how much we are going to add to the in the current year? Changes plus 20 million retained earnings we are going to add in the current year. So it means 20 million retained earnings we are going to add in the year. So this is going to be 20 plus 20 is 40 million of the retained earnings are going to be here as a closing balance. Then we have to take the next, these are the two internal sources of funds. Now we have to take the external sources of funds, and first is the secured loans. Secured loans. And if you talk about the secured loans, what was the secured loan figure? If you see that balance sheet here, the secured loans figure is given to us is the 80 million, right. And now in this new, how much is going to be the secured loan amount? So secured loan is going to be 80, we are going to put here, this is 80 million. And in this case, we are going to add something. So it was given to you that 20 million term loans we are going to borrow, 20 million. We are going to have the say additional term loan, we are going to have the additional term loan, and minus 5 million we were going to pay, right, we are going to repay. So it means what is going to be the net difference? 15 million. So total loan is going to be how much? 95 million. Total loan is going to be, so we are going to, originally we have the 80 million. In the n plus 1 year, we are going to borrow 20 million additional term loan, and 5 million we are going to repay. So net difference is going off 80 plus not 20 but 15. So this is going to be 95. And then we are going to have the unsecured loans. Unsecured loans. And how much was the unsecured loan figure? If you recall that previous slide, so you will find out it is 50 million. And we are going to have this 10 million proposed increase. We are going to borrow 10 million more unsecured loan. So you call it as the additional borrowings. So 10 million additional borrowings. So it is going to be how much? The total loan, unsecured loan, is going to be of the 60 millions. And finally, we are going to have the current liabilities. We are going to have the current liabilities. So, what are the current liabilities? Current liabilities are going to be 90 are currently available with us. Current liabilities, if you go back here, you will find out the current liabilities are of the 90 million, right? And in this 90 million, there is going to be some change in the current liabilities. So, at the moment, if you see the additional information, is there going to be any additional change in the current liabilities? So, it means it is writing current liabilities and provisions are expected to remain unchanged. So, no change is going to be there. It means current liabilities and provisions are going to be same. So, current liabilities are 90, no change, right. And finally, we are going to have this 90 millions of the current liabilities here available, and same is the case with the provisions. And provisions, we are not going to change anything here, and this is 20 million. So, it means this is going to be no change. So, 20 million is going to be the amount here. So, what is the total liabilities now? Total liabilities and equity. Total liabilities and equity is going to be how much? This is, if you sum it up, this is going to be 405 million rupees. 405 million rupees. This is going to be our, say, projected balance sheet, and this is the liabilities and equity, right. Now, we will have to go for the next thing, and that next thing is going to be the assets. We are going to have the assets here, and in this assets also we will discuss the assets in the next slide, and we will try to find out whether the assets also become 405 or not, 405 millions or not. So, for that purpose we are going to have the, say, asset side of the balance sheet now, and for that purpose we are starting from here. And assets are going to, we are going to take here the opening balance, right. This is the opening balance. Assets, then we are going to have the opening balance here. So, when we are going to take here opening balance of the assets, so it means this is the opening balance. Opening balance, then we are going to take the change during the year. Change during the year. Change during the year, and this is the closing balance, right. This is going to be the closing balance, CB. So, assets we are going to take here. First one is the fixed assets. So, what was the fixed assets given to us? If you go back into the original balance sheet and try to see here, fixed assets given to us are 180 million, right. So, in this 180 million, this original balance is, opening balance is the 180 million. Change during the year, additionally 30 millions of the additional fixed assets are going to be added. 30 millions of the fixed assets are going to be added. So, it means in this 30 millions of the fixed assets, we are going to have the some additions, and in this whole process, when you take here, this is going to be the plus. So, this change is saying that plus 30 million additional fixed assets are going to be there, and if from this we are going to subtract something which is 20 million as depreciation, right. So, it means net change is going to be how much? Net change is going to be 10 million, because 30 million we are going to add, 20 million out of this is going to depreciate. So, net increase is going to be 180 plus 10. So, this is going to be 190. So, it means the fixed assets are going to be 190 million, right. Increase in the fixed asset is there, but not a big increase, just by 10 million rupees this is going to be there. But let us talk about the investments. Investments. So, there is no investment at all, there is no opening balance, no change, nothing as a closing balance also. And then we have to talk about the current assets. Current assets. So, when you take the current assets here, in the current assets, this is the fixed assets. When you take the current assets here, so in this current assets, we will have to take here as the total current assets. If you see, go to the original balance sheet. So, total current assets are how much? Total current assets are 180 million here. So, out of this 180 millions of the current assets, we are writing here 180 million of the current assets we are writing here, and for that purpose, if you see the detail, first one is the cash, right. Second one is the inventories. Second one is the inventories. And next one is the receivables, accounts receivables, we call them ARs. So cash is how much? Cash is going to be 20 million in this, right. This is going to be how much? Cash is total is 180 million. So the cash is going to be 20 million. So it means we have to find out the total cash balance here and see the total changes in this. So it means opening balance of the cash was how much? 20 million. If you see the original balance sheet here, so the original balance is this 20 million, and from the this statement, the cash flow statement, projected cash flow statement, if you see here, we have found out the closing cash balance is 30 million. So it means 20 plus 10, 10 is from the surplus of the n plus 1 year. So total closing cash balance is going to be how much? This is going to be 30 million. So from this changes in the year, during there is a changes is of the 10 millions, right, plus 10 million addition. So it is going to be total cash is going to be with us is 30 million, right. And in this case we will have to find out 190 million of the fixed assets, cash is 30 million, and then we have to find out the inventory. So what is the original balance of inventory? 80 million. And in this, how much is we are going to increase it by 10 million. We are going to increase the inventory by 10 million. So the this total inventory is going to be 90 million. And similarly the accounts receivables original balance is 80 million, and we are going to increase it by 15 million. Expected increases by 15 million. So it is 95 million, right. This is 95 million. So in this case, the total, if you sum it up of all this, it comes up as 50 and it is 405, it is 405 M. So it means the total of the fixed assets means the asset side of the balance sheet. If you talk about the total of the asset side of the balance sheet, so these are the total assets, and the value of the total assets is the 405 million. In this, the fixed assets are the 180 was the original, now it has become 190 million in n plus 1 years. Then in case of the current assets, against the total 180 million, now the new balance has become, finally you call it as the new balance also. The change in the new balance is going to be total assets, if you talk about, they are going to be how much? This is going to be 215 million. This is going to be 215 million, the new current assets against the 80 million original balance. So it has become the 215 million. And if you see here, the total 190 million of the fixed assets plus this 215 million of the current assets. So total assets side of the balance sheet, projected balance sheet, is also 405. And here also, if you see here for the n plus 1 year, it is also 405. So it is equal to the total liabilities and equity 405, assets also 405. So it means now the balance sheet is balanced for the projected year. This is the n plus 1 year. So this is only 1 year of the projected balance sheet which we have tried to build up. And we could see here that original size of the balance sheet was how much? Original size of the balance sheet was 360 million. So that was in the year 360 million, right, and that was in the year n. And now this balance sheet has become of the how much? 405 million, and this is in the year n plus 1. It means this size of the balance sheet has increased from 360 million to 405 million, and this is a growing firm, this is a growing organization. And largely, if you see here in the n plus 1 year, if you see the profitability state, so you will find here the firm is earning profits, and it means it is not a loss making proposition, it is earning a profit of the 30 million it has earned. It has paid the dividend also in the first year itself, and it has reinvested to the tune of 20 millions back into the business also. And similarly, if you talk about the cash flow position of the firm, so in the cash flow position also we see here that we have a positive cash flow position, surplus is generated by the firm, and in this surplus generation of the resources, you can understand, you will see here that sources of the cash were 125 million, applications we have made of the 115 million. So the net difference of the cash is 10 million, which is a positive balance, which you call it as a surplus. And finally, the net balance, closing balance of the cash has gone up from the 20 million to 30 million. So all the indicators are positive, right? All the indicators are positive. If you, for example, if you talk about the profit, right. So it means profit after tax has also increased, right. If you talk about the cash flow, right, so cash flow also has increased, and you talk about the balance sheet. So balance sheet has also gone up, and it has produced a very good balance. So it means the balance sheet also is going up, and balance sheet of the firm has improved. So it means everything, all these assets and liabilities of the firm, profitability and cash flow has gone up. So profit after tax, when you talk about, if you see the profit after tax is, how much was the profit after tax? So we'll see here that we have earned the profit after tax is, that is 30 million. Then you talk about the cash flow, it has generated the 10 millions of the positive cash flow, which is a surplus. And if you see the balance sheet, it has become of the size of the 405 million. So it means all the three indicators, if you talk about this firm in the first year, that is N+1 year, first important thing is that the firm is earning profits. And in the first year itself, maybe in the current year, that was the first N year, you call it as, when the balance sheet size was 360 million. But in the first year, N+1 year, it has given all the positive indicators. If you see, it has earned the profit, it's not into the loss. Profit is also impressive against the total sales. Of the total sales were how much? If you see here the total sales, so against the total sales of the 400 million, it has generated a profit after tax in the first year itself of the 30 million, which is not a bad amount. And then if you talk about the cash flow position, so largely most of the sales they have done 400 million sales, so they have generated a profit of 30 million, but 10 millions of the cash they have produced. It means though the 2/3 of the sales are on credit, but still in the first year this kind of the performance is also not bad. It means 10 millions of the surplus they have generated. And if you see the balance sheet size, so it has also gone up from the 360 million to 405 million. It means the firm is growing as well. So it means all the indicators are quite positive, quite you call it as impressive. And this kind of the performance in the N+1 year will be interpreted as a very good performance by any investor. And this kind of the investment proposals or projects will get the investors easily. So you can understand now what is the purpose of preparing the projected financial statements and what purpose these statements serve. Because numbers when come in front of the investors, when you talk something in the abstract, in the conceptual form that we are going to sell this much, we are going to produce this much, we are going to sell this much, we are going to invest this much of the resources, we are going to convert that into this much of the fixed assets or the current assets. So that doesn't serve a very good purpose. But when you show the numbers and the projected financial statements, so you are going to give them a clear picture in the form of the numbers, and they can question these numbers also. For example, when you talk about say any kind of the numbers you're talking about, that say that the total investment is going to come from the promoters is 100 million. So they can say that this total investment you are saying 100 million, what are the sources of this investment? Is it only coming from the pocket of entrepreneurs, or it's coming from other sources also? And when you're showing the reserve and surplus of 20 million, so what is the source of this 20 million? And secured loan, unsecured loans, who is going to give you this money? And why should anybody give you secured loan? Secured loan is okay, but unsecured loan, why should somebody give you? So people can ask some questions and they can maybe raise some issues. Similarly, when you talk about this cash flow statement, so you can easily find out that what is going to be your profitability position, depreciation position, then secured loan, unsecured loan, and then is the capital expenditure, how much you are going to make additional capital expenditure in the N+1 year. And somebody may question you, why in the 1 year only you are going to make additional capital expenditure and you are going to have additional investment into the inventory and receivables and other things. So all these things, when in the form of the projected statements, when the details come in front of the investors, so they are easily available to you. They can raise some questions, they can ask some queries, and if you satisfy them and if you give them logical answers to those queries, so certainly it's going to serve a big purpose and it's going to give the good value to the enterprise, and raising of the funds in that situation will not be a challenge, will not be a problem. So finally, this is the projected balance sheet, cash flow statement and balance sheet for the N+1 year, which was based upon the initial information which was in the form of the balance sheet or the statement for the current year, that is year N. then the say one projected statement was already available with us, that is the income statement for n plus 1 year, and some additional information was also available with regard to changes in the asset and liabilities and cash position, or similarly sources and applications of the funds. So, on the basis of that input, we have converted the whole thing into the projected cash flow statement and projected balance sheet for the n plus 1 year, where we have found out that all the important indicators are giving the positive values, and these three indicators, profit after tax, cash flow position and balance sheet size, is indicating a growth and enterprise, kind of a growth enterprise, and is going to give the good value to the firm. So, for this kind of the ventures, maybe setting up of the ventures for this kind of the values or this kind of the financial statements will not be challenged to anyone. Maybe it is the entrepreneurs, or maybe it is the investors, or investors can be venture capitalists, or even with this kind of the balance sheet, even if you go to the financial institutions also, institutional investors also, they may also find a reason to make investment, because you are not earning any kind of, incurring any kind of loss, rather you are earning profit from the first year onwards, and your balance sheet size is also growing, and the cash flow balance is also positive. So, it is a good balance sheet, good cash flow statement and good profit and loss account, and if this kind of the ventures are there, or any venture if it is presenting this kind of the information, then certainly it is going to find a place in the industry, and is going to be supported by all the investors, all kind of, whether they are risk capital providers or whether they are the institutional investors, all will come forward and give you the funds, and sustainability will be ensured. As far as this kind of the firms are concerned, this kind of businesses are concerned, sustainability can be ensured. So, we will stop here for the moment, and in the next class we will see just a ready-made, that is the projected financial statements, not for 1 year, but for at least 3 years or 2 to 3 years, and they will be ready-made financial statements. Just a glimpse of that we will have, that if you want to make it for the multiple years, from 1 year to 3 years, or 1 year to 2 years, 3 years, 4 years or 5 years, because in practical sense you have to prepare it up to 10 years. So, how to prepare the multi-year projected financial statements, that we will discuss in the next class, and have a complete idea about that while going for estimation of the project finances and the profitability, what important requirements are there, precautions are to be taken care of, and how the projected financial statements for the multi-years can be prepared. So, till we discuss all these in the next class, we will stop here, and remaining part we will discuss in the subsequent class. Till then, thank you very much.